Hey guys, welcome to Investify, where we help you grow your wealth through smart investments. Today we will discuss the fascinating world of investing and explore a burning question: which ETF can transform you into the ultimate money-making machine in just 10 years? Get ready as we compare the heavyweight contenders, the dividend ETF and the growth ETF. Many ponder whether to invest in a brokerage account, fully aware of the inevitable tax implications. But fear not. In this video, I'll provide real-world examples that highlight the disparity between dividend ETFs and their ambitious counterpart, growth ETFs. We'll unravel the mysteries of numbers and explore the tax implications that may arise over the next glorious decade. Armed with this knowledge, you'll be equipped to make an informed decision. Dividend investing, the irresistible allure of every investor's quest for financial bliss. Imagine a future where your dividend income flows endlessly, sustaining you without ever selling a single share. Fear not, brave investor. By the end of this enlightening journey, you'll possess the wisdom to make a prudent decision. So sit back, relax, and get ready to dive deep into the thrilling world of dividend ETFs versus growth ETFs. Your financial future awaits. Some people prefer to choose growth ETFs to avoid taxes on dividends. They think, why bother with stocks that pay dividends and incur quarterly taxes? This line of thinking leads them to explore options like growth ETFs, growth stocks, or even foundational ETFs. Even the mighty S&P 500 offers a modest dividend, but it pales in comparison to funds like SCHD or JPEI, which provide higher cash flow. However, there's a catch with these types of funds. If you rely solely on them during retirement, you'll have to sell shares to access your money. Let's say you have 10,000 shares, which may seem substantial, but if you need 1,000 shares to cover your living expenses, you'll have to sell them. This poses a dilemma. Many people devise a plan. They invest in growth funds until they reach retirement age. Then they sell their stocks and funds, transferring everything into a dividend ETF or similar option. At that point, they rely solely on the dividend income, avoiding taxes until then. So which path is truly better for you? Which approach should you take? Where is the best place to invest a lump sum and how stocks are taxed? If you have a lump sum of $20,000 and are deciding where to invest it, you may be considering a dividend ETF like SCHD or a growth ETF like SCHG. Let's explore the total return and tax implications to help you make an informed decision. On average, SCHD has experienced an annual appreciation of over 13% in total return. This figure includes both price appreciation and dividends. It's important to note that total return accounts for both the fund's compound interest and the traditional income from dividends. Now, let's focus on the dividend portion of the total return. It's crucial to consider the tax payments on dividends. When stocks are taxed, capital gains tax is applied if you have held the stock for at least a year. This type of tax is more favorable compared to short-term taxes. Long-term investing is often encouraged due to the significant advantage of lower tax rates. Capital gains tax has multiple tax brackets, but most individuals fall into the 15% bracket, considering their earned income and dividend or investment income. Depending on your overall financial situation, this is the tax rate that would apply to both dividends and profits from selling stocks. With this information, you can weigh the options and determine the best course of action for your investment of $20,000. Let's analyze the total return of a dividend ETF using a simple Excel spreadsheet. Starting with a $20,000 investment and assuming a 13% appreciation, the ending balance after multiplying would be $22,600, which a dividend yield of approximately 3.5% or 0.035. The annual dividend amount of $791. Applying a 15% tax rate to the annual dividend, the taxes for the first year come out to $118. Over a 10-year period, both the annual dividends and taxes gradually increase. At the end of the 10 years, the ending balance would be $67,891.35. However, to obtain the actual final amount, we subtract the total taxes paid, which amount to $2,185.50. Consequently, the final sum would be $65,705. These calculations specifically pertain to the dividend ETF SCHD. Analyzing the total return of a growth ETF is simpler as it doesn't require individual dividend considerations. Using the average 10-year rate of return, such as the 13.9% of a repeatable growth ETF like SCHG, we can input this rate into a compound interest calculator. The calculation reveals an ending balance of $73,496. However, it's crucial to factor in the tax implications of selling all the growth ETF shares to invest in dividend ETFs for generating retirement cash flow. Selling the shares incurs significant taxes due to capital gains. In a similar manner, starting with a $20,000 investment and an ending with $73,496, the capital gains amount of $53,496. Applying a 15% tax rate to the capital gains results in a tax payment of $8,024. Subtracting the taxes from the ending balance, the total capital remaining after this process would be $65,472. Comparing these results to the dividend ETF scenario, the difference is relatively small, around $250. In conclusion, both approaches yield similar outcomes. The choice between investing in a dividend ETF or a growth ETF depends on individual preferences and goals. When comparing the total return of a dividend ETF like SCHD with a growth ETF like SCHG, the choice depends on individual preferences and goals. Opting for a dividend ETF allows you to pay taxes gradually through the received dividends, which may result in a more balanced total gain. On the other hand, choosing a growth ETF focuses on maximizing growth potential, and the tax payment is deferred until selling the shares to generate cash flow through dividends. This approach may result in a larger tax payment but potentially higher overall profits. Ultimately, the decision depends on personal circumstances and desired investment outcomes. Why do I choose dividend ETFs long-term? When considering long-term investments, choosing dividend ETFs can be beneficial if your goal is to have consistent cash flow throughout your life. This approach provides peace of mind, sustainability, and the potential to pass on assets to future generations. Don't be discouraged by concerns about taxes when investing in dividends within a brokerage account. While investing in a Roth IRA offers tax advantages, there are limits to the amount you can contribute. To achieve greater financial freedom, combining a dividend ETF and a growth ETF in a brokerage account can lead to significant wealth accumulation. Will you seize the opportunity to boost your net worth and embark on a thrilling 10-year journey of wealth creation? Well, prepare to have your net worth skyrocket faster than a rocket-powered unicorn. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.